Okay, so risk-free rate. So the best proxy we have for the risk-free rate is Treasury securities. They're a close proxy for the risk-free rate. They, that's the U.S. Treasury securities are the most liquid, most widely traded securities in the world. Especially MT bills are the most liquid type of treasury skill. So the CAPM is a period model. So projects are long lived. So the average period or short-term rates need to be used. So the historic premium for long-term 20-year rates over short rates over government securities is in the range of 1 to 2%. So that we could estimate the risk-free rate that to be used in the CAPM 2% below the prevailing 20-year Treasury securities. I think if we did that at this point in time, we would be estimating the risk-free rate is somewhere around 0, which it wouldn't if we used T-bills, it wouldn't be much more than that. So anyway, just we'll for the problems we'll work, we'll be given a risk-free rate, so that we don't have to actually determine one. To calculate market risk premium, different methodologies. First methodology is they're using historical data. The method 2, we can use the dividend discount model. So market data and analyst forecasts we can use to calculate the dividend discount model. So on a market-wide basis. So estimation of beta. So market portfolio of all assets in the economy and practice. Broad stock markets such as the S&P 500 is used to represent the market. And in most cases, researchers use the S&P 500 as a broad measure of the market. So what is beta? Beta is the sensitivity of a stock's return on the market, stock return to the market portfolio. So we calculate beta, as we mentioned in the previous lecture, covariance of the return on the asset minus to the return on the market divided by the variance of the return on the market. So problems with beta may vary over time. Sample size may be inadequate. As we mentioned previously when we talked about the CAPM, we're using this type of analysis. It's called mean variance analysis. We're assuming that the returns are normally distributed. In order for that estimation to be accurate, we need a sample size, a fairly significant sample size. Betas are influenced by changing financial leverage and risk or business risk. So solutions. Problems 1 and 2 can be moderated with more sophisticated statistical techniques. Problem 3 can be lessened by adjusting for changes in business and financial risk. 3, look at the average beta estimates for comparable firms in the industry. So we can, as opposed to using a firm's beta, we can use an average beta for that industry or comparable firms in the industry. The stability of beta. Most analysts argue that betas are generally stable for firms remaining in the same industry. That it's not to say that betas don't change. Changes in product line, changes in technology, deregulation, regulation, not mentioned here, changes in leverage. using an industry beta. It's frequently argued that you can better estimate a firm's beta by involving the whole industry. If you believe that the operations of the firm are similar to the firms of the rest of the industry, you should use industry beta. But if the firms are fundamentally different from the operations of the rest of the industry, you should use the firm's beta. And don't forget about adjustments for financial leverage. So, determinants of beta, business risk, cyclicality of revenues, operating leverage, financial risk, financial leverage. The cyclicality of revenues. Highly cyclical stocks have higher betas. Evidence suggests that retailers and automotive firms fluctuate with the business cycle, while transportation firms and utilities are less dependent on the business cycle. Cyclicality is not the same in variabilities with high standard deviations. Need not have high betas. For example, movie studios that are variable depend on whether they produce hits or flops, but their revenues may not be especially dependent on the business cycle. Depend on the success of those movies. Operating leverage. The degree of operating leverage measures how sensitive a firm or project is to its fixed costs. Operating leverage increases as fixed costs rise and variable costs falls. Operating leverage magnifies the effect of cyclicality on beta. So in the first so on the left-hand side, we've got our first example here. We got low fixed costs and our total costs on the red lines. And we have our beta, which is fairly flat. So if fixed costs rise, there we go. So when fixed costs rise, the impact of operating leverage is increased, resulting in a higher beta. So the variable costs are lessened, but we end up with the steeper green line over here. This represents a higher beta, a higher slope. The red line is a lower slope. So we're going to start the next lecture with financial leverage and beta.